Hi, it's Jack here at System Trader, and in this very short video I'm going to discuss two major approaches to investing: active and passive. And let's start with the passive. As John Jack Bogle was saying, rather than looking for a needle in a haystack, you can just buy the whole haystack. And the same approach is in investing. Rather than doing stock picking, you can buy the whole stock market, even on a global level. So you can just buying an ETF with global exposure to equities, you can have just own the whole global stock market. So this is a big advantage of passive approach, because you just buy and hold it. You don't have to try to do anything else. Of course, you can add to the portfolio some other asset classes, like, for example, fixed income, bonds, or commodities like gold, and so on. And then, because, for example, stocks historically were growing very fast, faster than, for example, bonds, you have to do so-called rebalancing. So let's say that you decided that you want to have 60% in stocks and 40% in bonds. At some point, it may happen that, for example, you will have 70% of stocks in your portfolio. Therefore, you have to do rebalancing. But this is a very, let's say, lazy operation. It's not happening every day, every week. You can do it on a monthly basis, quarterly basis, or yearly basis. There are many approaches to that, and I covered that topic in a different video. The good thing about that is you don't try to beat the market. So you just buy and hold the whole market. So because of that, you can lower your costs very, very much, because you just hold ETF, for example, which is almost free. You can pay for it like 0.1, 0.2% per year. And that's it. There are not too many transaction costs, only for rebalancing or when you are adding new capital or you withdrawing some capital from your account. And because of all these things, there is a little time needed to manage such portfolio. So you don't have to think about your investments on a daily basis. You can just build such portfolio and almost forget about the markets, and just let the markets do their job. And on top of it, you have a guarantee of investment result, which means that if the market is, I don't know, growing by 10%, and you own that market, you will also have that 10% profit. So basically, you cannot expect that you will have a better result than the market, but also you will not have the result worse than the market. And as many statistics are showing, majority of active funds, where managers are trying to be smarter than the market, majority of them are losing with the market, are actually beaten by the market, although they are willing to beat the market, but in fact it happens that they are beaten by the market. So here you have that guarantee of investment result, that you will end up with the result as the market gives. And historically, for example, we know that equities are giving us like 5% in real terms, meaning after adjusting the inflation, and the fixed income historically were giving us around 2% in real terms. Although for the fixed income, it's a more, let's say, it's a tougher period now, because we are in the era of the low interest rates. Therefore, it will be not that easy for that asset class, but I will cover that in a separate video. And if you want to go that way with a passive approach, you can just use for that ETFs, exchange traded funds, which are listed on the stock exchanges, or you can buy index funds. They are very similar to ETFs, but they are not listed on the stock exchanges. Or you can delegate that work to some services like robo-advisors, for example, and they will build such portfolio for you. On the other side, we have active approach, and in that approach, as the name implies, the portfolio allocation may change in response to market changes. So there we had in the passive approach, for example, 60% of stocks and 40% in bonds, and we were not trying to for example, sell bonds because we were thinking that bonds will have a tough time, or sell stocks because we were expecting that there will be a bear market. We were just holding that portfolio all the time in the same proportions, of course, with the exception to make the rebalancing. Whereas here with the active portfolio, its allocation may change in response to market changes. And for example, there is a well-known strategy by Gary Antonassi, Global Equities Momentum, which holds stocks when the market is going up, stock market is going up. But once the stock market is going down, at some point we are selling stocks from our portfolio, and in that place we are putting fixed income bonds. And there are multiple goals for the people who want to invest actively, not only to have the higher profit, not only to beat the market, but maybe because, for example, they want to have the exposure to the dividend stocks, and they are not happy with what ETFs specializing in that are providing. So then they are just doing that stock picking because they want to have dividend stocks, and there is nothing wrong about it. I mean, if you want to go that way and you are aware of what you're doing, that's fine. Also, maybe some people are going towards strategies which are, at least on paper, promising less volatility than if you would go with a standard passive approach. But the problem is with the active approach is that the results of the investment is not guaranteed. And by the way, nothing in investing is guaranteed. But with the active approach, you have that risk that your investment will have a worse performance than the whole market. So quite often you will look differently. And this is tough because if you see that a simple index like, let's say, S&P 500, is beating your strategy for years, then it will be very difficult for most of the investors to follow such active strategy. And quite often you have to be prepared for the long, extensive periods where your active strategy will underperform. And the active approach may also require a bit more, or even quite a lot of more, time commitment. And this may vary quite greatly because, for example, you may have an active strategy like, again, Global Equities Momentum, which I mentioned, which will require you no more time to devote than, let's say, standard passive approach. But you may, on the other hand, imagine a stock picking strategy where you want to analyze each stock and read the reports and do your own analysis, and that may create a lot of work for us, even hours per week. So you have to just judge how much time you really want to devote to your investing. By the way, I'm a quant, so I definitely prefer such approach as, for example, Global Equities Momentum, where although I'm doing that actively, I mean investing actively, I can devote to it just a few minutes per month or even per year. And similarly as for the passive approach, you can buy such, create such portfolio or such strategy, active strategy, using also ETFs, stocks, but also you can use derivatives like futures, like options. So there are bit more flexibility in how you can build such portfolio, but also there is more risk that if you are not doing that, let's say, consciously, and your expectations are not really healthy, then you may end up with something which is only looking good on the paper, but it will fail in the reality. So active investing, I'm not dogmatic here, it's possible, and I do believe that some investors can do it, but you have to be aware of the risk you are taking. On the other hand, passive approach is also very, very nice approach for majority, maybe even of investors, but it's not as simple as it seems to be, because there are also an extensive periods of times where you will be underperforming. I mean, underperforming in the way that the whole market is just going through a severe bear market, for example, and even for years, your portfolio, passive portfolio, can be underwater, as they say. And here I put some sample portfolios just to give you some, let's say, information what you can expect using different approaches. And on top of that, we can see S&P 500. Let's say it's our benchmark, and we can see that between 1970 till the end of 2020, with the starting capital $100,000, we would have $19.3 million at the end after that period. On the other hand, 60-40 portfolio, very classic portfolio, which I already mentioned in that video, where we have 60% of total return S&P 500 index, and on top of that, we have 40% in fixed income, like, for example, 10-year government bonds. The annual return is a bit smaller than with just 100% in S&P, but you also have less maximum drawdown, because rather than 50%, you have 31%, and the ending capital is significantly smaller at the end. So although that difference here is not that big, 10.9 versus 10.2, it doesn't sound like a big difference in the investment, but in the long run, it's a huge difference, because at the end you have 19 versus $13 million. There are also other, let's say, more sophisticated portfolios like All Seasons or Permanent Harry Brownie, which also has gold. Actually, both of them, they have gold. All Golden Butterfly, obviously, as the name implies, also has gold. And that portfolio, by the way, from the 70s was having a brilliant performance, although we have to take into account that there is 40% of bonds which had a great performance from the 1980 till today, and most likely that great performance for bonds will not happen again. But anyway, for the last, let's say, 50 years, it had a great performance, and at the end we would end up with over $21 million. There is J.L. Collins, known person from the FIRE movement, where we have actually 75% of the S&P 500 here and 25% in the fixed income. So let's say it's a bit more aggressive version to the 60-40 approach. And last but not least, just to give you some feeling, all these here portfolios are purely passive, but now I'm showing you global equities momentum, the portfolio with the strategy which was invented by and introduced by Gary Antonassi. I had a pleasure to have him on my podcast twice, and as you can see, the difference is absolutely huge. So here, annual return in nominal terms is almost 15%. After adjusting the inflation, we have over 10% per year on average. And with quite modest drawdown, there is a monthly data, so it's around 20%. In fact, that drawdown is a bit bigger. It's around 30-something% if we would use the daily data. But quite often when we want to reach many decades in history with our backtesting, we cannot have the daily data. We have to use the monthly data, and then you may not see that drawdowns. But anyway, that drawdown was not very severe, and also the ending capital it's just amazing, because as you can see, that difference between even Golden Butterfly, which among passive portfolios had the best performance, and as you can see here, 11.1 versus 14.7 after 50 years, it's a huge difference, 21 millions versus 105. So just keep in mind that just every 0.5% in your annual return it's making a huge significant difference long term. And by the way, if you'd like to play a bit with your own portfolio, or just to see or look for some inspiration for some portfolios, I encourage you to have a look on my software, ST software, where you have over 40 portfolios built in, built by many known managers. Also, you have the global equities momentum strategy, which I mentioned, and you can just play a bit with the parameters there. There is also a strategy for, let's say, stock picking, but also based on the momentum. And by the way, you have the possibility to test that these all portfolios even up to 120 years, because the data is built into that software. And on top of that, you can monitor your portfolio on a daily basis, because you have access to 70 exchanges worldwide. So you can not only see what was happening 50 or 100 years ago, but you can also see what is happening now. If you are just running a portfolio and you want to take actions, generate signals or whatever. And by the way, you have the priority technical support. So if you buy such software, you have access to me, and you have the guarantee that this price will not change. So per year, it's 179, and this is only till the end of November, and then there will be increasing price. So that's why I encourage you to take action on it now. And always, whenever you have active license, you have the latest updates, and the software is being constantly developed so that you have access to the latest version, and there are new strategies on the way. That's all from my side. If you'd like to check my offer, go to systemtrader.show/shop. Thank you very much for your attention. Bye-bye.